What is amortization? Amortization refers to the process of paying off a loan over time by making regular payments that include both principal, the amount borrowed, and interest, the cost of borrowing the money. Each payment reduces the outstanding balance of the loan until it is fully paid off. It's like paying back a friend who lent you money by giving them some money back each week until you've paid them back in full. When you decide to buy a house, you will most likely need to take out a mortgage, which is a loan that you use to pay for your home. There are different types of mortgages available, each with its own terms and conditions. A fixed mortgage is a type of loan where the monthly payment amount stays the same for the entire term of the loan. This can be helpful for budgeting because you always know how much you will need to pay each month. Adjustable rate is a type of loan where the interest rate can change over time, usually based on a market index such as the prime rate. The index is like a scale that measures how much it costs to borrow money. So if the index goes up, your interest rate might go up too, and that means you might have to pay more each month. But if the index goes down, your interest rate might go down too, and you might end up paying less each month. That's why it's called adjustable, because the interest rate can adjust or change over time, which can make budgeting more difficult. Option arm or negative amortizing is a type of loan that allows you to pay less money each month than what you actually owe. The borrower has the option to pay less than the interest owed each month, resulting in the unpaid interest being added to the principal balance of the loan. The extra money you didn't pay gets added to your loan balance, which means you'll owe more money in the future. This can be risky because it makes your loan more expensive over time, and you may end up owing a lot more money than you originally borrowed. It's important to make sure you understand how this type of loan works before you decide to get one. A prime mortgage is a type of home loan for people with excellent credit and a stable income. With a prime mortgage, you can get a lower interest rate than if you had a lower credit score. You'll need to make regular payments to pay back the loan, which will depend on the interest rate, length of the loan, and amount borrowed. A down payment of at least 20% of the home's purchase price is usually required. It's a good option for people who can afford the down payment and monthly payments and want to start building equity. Alt-A is a special type of mortgage loan that is given to people who might not have a perfect credit history, but they are not considered high-risk borrowers like those who get subprime loans. Alt-A loans may have different requirements than regular loans, and may come with a slightly higher interest rate. They can be helpful for people who don't qualify for regular loans but still have a good chance of paying back the money they borrow. Subprime mortgages are a type of home loan given to people who have a lower credit score or who might not have a lot of money. These loans are riskier for the lender because there is a higher chance that the borrower might not be able to pay back the money they borrowed. That's why subprime loans usually have higher interest rates and fees. Unfortunately, during the 2008 financial crisis, many people who had subprime loans were not able to pay back the money they owed, which caused a lot of problems for the economy.